the Board of Directors. The board is responsible for overall governance, strategic direction of the company, and ensuring compliance with the laws. Let's take the case of Yes Bank to understand the typical structure of the board of directors in a company. Yes Bank faced a big crisis in 2020 when it had faced governance issues, it had given out loans to companies which could not be recovered, and people were afraid that they won't get their deposits back from Yes Bank. In this situation, RBI intervened and took over management and imposed temporary halt on Yes Bank's operations. After it got a bit settled, SBI rescued the bank after it was facing all these issues in raising money and helped the bank to grow back. SBI took ownership of around 50% of Yes Bank and invested around 6 to 7,000 crore rupees for that. The difficulty arose because after Yes Bank's collapse and misgovernance issues, the bank was not being trusted to raise money. Therefore, SBI had to intervene and inject this money. Also, RBI allowed some private equity investors to invest in the bank as well to the tune of about 20%, and thus Carlyle and Advent International, which are private equity investors, also invested in Yes Bank. Now this is what the board of directors looks like in Yes Bank. Let us understand the types of directors which exist. The first would be the managing director of the company. The MD supervises or directs the entire company, and the buck stops with the managing director. Number 2 are the executive directors and non-executive directors. Executive directors are actively involved in the management of the company, while non-executive directors do not participate in the daily operations but offer merely strategic guidance. Now you can see in the chart as well that the executive director is managing other business heads of the company like the COO, which is the chief operating officer, the CMO, the chief marketing officer, and many other country heads of different branches of the company. Next, we come to the independent directors. Independent directors are meant for ensuring corporate governance in the company and are supposed to protect the minority investors, which is a mandatory requirement for listed companies. Then come nominee directors. Nominee directors are usually appointed by lenders, that is the people who are giving out loans to that company, or investors. Like in this particular case, SBI was an investor along with other private equity firms like Carlyle and Advent, and all three of them had nominee directors in Yes Bank's board. These nominee directors can also be appointed by regulators like RBI, as has happened in the case of certain banks like Ujjivan Small Finance Bank, and the withdrawal of such a director which has been appointed by the RBI also signals a boost of confidence from RBI in that particular bank, and it gives the investors confidence to invest in the company. It means that the RBI has enough confidence that the bank can now run on its own. And lastly, there is a requirement of women directors, which basically means that there should be one woman director in the board. But why were SBI and other private equity investors so worried about getting a seat on the board of directors? Having a seat on the board for anyone is so important. It is because the board approves multiple important actions of the company via resolutions that the board passes. There are multiple roles and responsibilities that these directors have to fulfill. Some key responsibilities include, first, being the fiduciary duty. Fiduciary duty basically means acting in good faith and in the best interests of the company and shareholders. However, the interests of the board and shareholders don't always align. This is also called the agency problem, since the board is managing the company for the shareholders as their agents. One such example of a conflict between shareholders and management can be the fact that the management is taking a higher salary than the shareholders would like. Why is that? Because if the management is taking a higher salary, that would mean a higher cost for the company and less profits for the shareholders. And there can be similar conflicts that can arise between the board and the shareholders. The second responsibility of the board would be ensuring corporate governance. So there are multiple laws and compliances that the company has to abide by, and the board's responsibility is to make sure that the company is complying with SEBI, RBI, Companies Act, and all other applicable laws. Third would be maintaining financial oversight over the company, which is approving budgets, the company's financial statements, investments, etc. Fourth would be the stakeholder protection, which is balancing interests of different stakeholders in the company, which can be the employees, creditors, regulators, and the shareholders themselves. Fifth would be appointment of key executives. So hiring and evaluating the CEO, CFO, and other senior management officials is also the responsibility of the board only. And sixth and last would be policy formulation. So what kind of policies would the company follow regarding dividends, mergers and acquisitions, and CSR or corporate social responsibility initiatives is also the prerogative of the board. For doing all these things, the board of directors passes resolutions. Now these resolutions are broadly of two types. First would be an ordinary resolution, which requires a simple majority, that is greater than 50% of the directors which are present in a meeting and voting, their votes are considered. If more than 50% vote in a particular resolution's favor, that resolution passes. Some important things for which ordinary resolutions are required are approval of the financial statements of the company, appointment of the auditor of the company, declaration of dividend, and the appointment and removal of the directors themselves. So these things require a simple majority. However, there are certain issues or actions which required a 3/4 majority or 75% majority among the board of directors who are present and voting in that meeting. Some of these actions are alteration of the memorandum or articles of association of the company, because they constitute the core object of the company, the procedures governing the company, etc. So if you have to amend these documents, you have to take approval of 75% of the board. When you want to buy back shares also, when you're deciding to wind up the company, and when you want to remove an auditor before their term is expiring, for all these things you are required to pass a special resolution. Now, as you can see in the annual report of Yes Bank, there are multiple committees which have members of the board of directors and some employees of Yes Bank as a part of those committees. Now let us understand the roles of some of the major committees that are required for any company. Number one, and a very important committee at that, is the audit committee. The audit committee is responsible for overseeing the financial reporting, appointing the auditors, and monitoring their independence. If there are any issues, the audit committee can flag these issues. Number two, Nomination and Remuneration Committee. The NRC formulates the criteria for director qualifications and recommends the remuneration policies for the company. Number three, the Corporate Social Responsibility or the CSR Committee. The CSR Committee is required for companies meeting certain financial thresholds. It oversees CSR initiatives of the company, that where would the money be spent, which initiatives does the company have to incur, etc., etc. And lastly, the Risk Management Committee, which evaluates and develops risk mitigation policies, which basically evaluates the risks that the company is facing, and it develops mitigation strategies or strategies through which the risk can be minimized of the company. Also, if you're investing in a company as an investor, the remuneration that the directors are receiving is a key consideration for you to judge, because if the directors are receiving a very high compensation in comparison to the company's profits or the company's revenue, then that would probably be a red flag for them, because their profits or the amount that they can receive as shareholders directly reduces. And moreover, it is also at the other end, besides the conflict between the directors and shareholders, it is also important to realize that if a large number of the member of board of directors are resigning from a company, it can be a red flag, because whenever any case happens before any tribunal and the company is supposed to be held liable, the people who are held responsible for the company's actions would definitely be the board of directors, and within those board of directors as well, the executive directors who are taking the key decisions would definitely be more liable, or they would have to incur a higher penalty amount than the independent directors.